The July CPI report just came out and this number affects everything. In this video, we're gonna go over what the July CPI says, how the market is reacting, why this matters for investors. We'll talk about a couple different things, my take as an investor right now investing, and then a final hot take at the very end. But before we get into the video, 90% of you guys watching aren't subscribed. So if you would please click that subscribe button to get more videos like this and tell me that you're interested in videos like this, that would be super helpful. If you're serious about real estate investing, or financial freedom, do me a favor, hit that subscribe button right now. Also, I want you to comment down below what you're investing in right now. Stock market, real estate, Airbnb, whatever it may be, anything crazy, comment it down below. What are you investing in right now? All right, with that being said, let's dive into the video. So what does the July CPI say? Today's CPI report shows that inflation came in at 3% year over year. That's down from 3.3% last month. It's the lowest inflation rate in over 2 years. And monthly CPI was just a 0.1%, which is basically flat. So yes, inflation is cooling, but the Fed is watching very, very closely with what's going on. How is the market reacting to all this that just dropped today? The stock market popped at the open. Treasury yields are slipping slightly, a signal that markets believe the Fed may pause rate hikes or even cut sooner, which is great because if they pause rate hikes or cut sooner than what they anticipated due to this new CPI report, that could explode the real estate market. Mortgage rates haven't dropped yet, but now they're under pressure. So what does this mean? Why does this matter for investors like you and me? So here's the key. Lower inflation means lower interest rate pressure, which means cheaper financing. And once you have cheaper financing, that leads to three things. Financing gets cheaper, buyer demand rises, and rents stay strong. So let's go through them. If rate cuts happen or even stall, investors can lock in better debt. And that means better cash on cash returns. It means refi opportunities open back up. It means more deals become viable, right? Because if you can get cheaper debt, you can go buy something way cheaper than you could 12 months ago. You're gonna now go and buy that property. There's gonna be better ROIs. People can start refinancing their properties again, and it makes way more deals make sense than are on the market right now. And this, coupled with the amount of inventory that's out there right now, it's a buyer's market. The United States just turned into a buyer's market, and now, because we have that buyer's market and we're gonna see interest rates come down, it's gonna be a recipe for just like a great time to go out there and invest and buy some real estate. All right, so buyer demand may rise. So for example, if rates were to come down, more home buyers re-enter the market. That means less distressed inventory, tighter competition for flips, potential home price appreciation in select markets. It also just means that that buyer's market is gonna turn very, very quickly. And all that inventory is gonna catch up very fast, which typically, like if you look at the actual graph of like the demand of real estate buyers, versus like the sellers, and you see it go up and down, up and down, up and down. It typically doesn't last very long where it goes from a seller's market to a buyer's market to a seller's market. It's typically within like a 12, 24 month period that all the inventory kind of gets eaten up super quick. So I think that that's what's gonna happen here as well. I think that we're gonna see all of those houses that are being sold from the sellers right now kind of get eaten up if this does happen and if rates do come down, or if there's no pressure to kind of like increase the rates like they've been doing. So what's my take? I think this is good news, but we're not out of the woods yet. I don't want to assume 5% mortgages are coming back overnight. Right now, we're probably at like 6 to 7% interest rate. And I don't think 6 to 7% interest rates are that bad. I think it's just like the US just has to get used to that. We've been so used to 3%, 2%, 4% for so fucking long that it just doesn't make sense to like continuously think that we can be at that interest rate. If you look at the interest rate graph over the last 100 years, I mean, like 3% was an anomaly, right? And we were never gonna get as cheap a debt as that before. But now I think if we're at 6%, if we can go back down to 5%, I still think that would be outrageous if we can get back 5% mortgages. I think that's just super, super cheap. But that's my assumption. I'm still going to run all my numbers and all my deals at the current interest rate, not assuming anything. But I think some people are going to start looking at some deals or just like getting everything prepared to start buying once interest rates come down a little bit, which I do think that they will. So I'm also focusing on fixed debt while it's available. I'm not doing anything variable. Everything I'm buying is going to be like a 30-year amortization, 5 to 10-year term, especially for multifamily. So I'm actually buying right now, the biggest thing is multifamily apartment buildings across the Midwest. And actually I have a real estate fund, Red Brick Equity. The link's down below in the description, the first link. If you want to book a call with my team and I, you have to be an accredited investor, make over 200 grand a year. But if you actually want to partner up and buy apartment buildings with me and my team, you can go ahead and do that. Click the first link. That's the biggest push that I'm making right now, is buying multifamily apartment buildings. And the reason why is because a lot of the people who bought 5 or 10 years ago, their mortgages are coming due, because multifamily only has a 5 or 10-year term. So their mortgages are coming due, and now we're in a buyer's market, right? So a lot of these guys who bought at 2, 3, 4% interest rates, now their loans are coming due and they're at 6%, 7%. They either have to refinance or sell. And most of them, the refinance is not going to make much sense. They're going to have to sell, and they're going to have to take a little bit of a haircut, or just like break even, which means you can buy properties from 10 years ago at the same price that they were 10 years ago, but you buy them in today's dollars, which is insane. So that's the biggest push that I'm making. And a lot of my deals, all my deals are cash flowing today around 10%. All the apartment buildings that I'm buying are cash flowing at 10%. All the single family houses that we're selling on martelturnkey.com, we sell like 10, 20 houses a month on martelturnkey.com. All of those houses are cash flowing today at 10, 15%. So those are kind of the two things that I'm kind of looking at. And I would say, like, if you can get 10% cash on cash return today with a 6 to 7% interest rate, you're in pretty good shape if something is turnkey and doesn't need a ton of reno. So smart investors win in transition like this, not when things are perfect. So this is when I would go out there and try to get everything prepared so you can start buying over the next 6 to 12 months. My hot take, this CPI number matters, and I'll be watching the Fed's next move very closely. If you're investing right now, like I just mentioned, get your capital ready, get your financing ready, know your break-even numbers, start looking at deals. Just get in the habit of start looking at deals, start looking at different things to invest in, whether it's real estate or stocks or whatever it may be. Just start getting everything prepared, because I think the next 12, 24 months, we're gonna see some shifts happen. Cool, thanks for staying till the end of the video. Drop a comment where you're investing, like this video, and please, to the 95% of you that aren't subscribed that are watching this video, please, please, please subscribe. It'll help me out tremendously. Thank you so much. See you on the next one.